Then Adam, feel free to wait till 9:03, 9:04 to start as people start trickling in.
For sure.
Put on a jacket for you guys. Just want to let you know. How's the green screen look? Like I
actually, the green screen looks amazing. I can't get mine to look that good.
Yeah, it is. It has been quite the experiment. So when COVID started, we got shut down, and for a long time, 20 months, but who was counting? I was answering the agent hotline number, which was the silver lining. I really I learned a lot, and I was able to troubleshoot a lot. So I learned a lot about my company. I learned about the process. I had way more interaction with agents, nationally instead of the whiny guys I usually deal with. And so it was a good thing. And one of the webinars that I attended was talking about this, when you do screen time, and the back of your camera is showing an unmade bed or a nasty looking desk and whatnot, you lose focus. So for $50, I got a green screen. Another $50, I bought myself a new camera, and it took a while to kind of figure out which way to go.
Yeah, it looks great. You don't see any edging around you or anything.
Yeah, the problem is behind the green screen is a couple windows, and on a sunny day, hold on, I got it. Over here, you get a little, little twinkle,
Good morning, everyone. Thank you so much for joining. We're just going to hold for another minute or two for a few last minute join, and then we'll go ahead and get started. Thanks so much. We'll be getting started shortly.
You got a note in your chat room, somebody having troubles getting in or something? You see that?
I don't see. That's just me. I put something in the chat. Well.
Oh, okay.
Yeah, we're good. All right, so I think in the interest of time, we'll go ahead and get started. Good morning, everyone. Thank you so much for joining. Really appreciate you taking time out of your day to join us for a great conversation here about some opportunities to help your clients. If I haven't had the pleasure to meet you yet, my name's Adam Savard. I'm the newest member of the marketing team here at Specific Solutions, and we are thrilled to be joined today by the manager of new business development, Steve Little, from Prosperity Life. Steve's going to take us through a great presentation with our rising interest rate environment, some great conversation opportunities for your clients. So without further ado, Steve, I'll turn it over to you.
Well, good morning, everybody. And again, thank you for joining us. So I am Steve Little. I am with SBLI USA. The corporate name is Prosperity Life. You'll see us under both names. I am going to shut my camera off. So there we go. All right, so we are going to talk about fixed annuities versus asset transfer, and the pros and cons and the benefits of either of these scenarios. So there we go. My fixed annuity is called Select Choice. We call it Select Choice because it gives you the opportunity to work with the needs of your customer. We have a 3-year, a 5-year, and a 7-year rate guarantee. So let's take a step back for a second. It is an MVA contract. So that's a market value adjustment contract, which basically means at the end of the guarantee period, there is a window, 30-day window, where you and your customer can decide whether rolling over the contract or moving it is in their best interest. During that 30-day window, there is no surrender charge or negative MVA affecting it. It is RMD friendly, and that's real important. Also, I'll explain that more later. But the annuity, as many non-qualified 0 to 85, qualified 18 to 85, we will take $5,000 for non-qualified, $2,000 for qualified, and up to $5 million. We will take up to $1 million without prior approval. If you have a contract for more than $1 million, all you need to do is get word to us through Specific Solution. We're going to want to know where is the money sitting currently, and how old is, who's going to be the owner, how old is the annuitant, and some simple questions like that, and we will be able to determine whether we could take that money. We have a 1% rate guarantee. That's New York 60-day rate lock. And that works whether the rate is going up or down. So we recently announced a rate increase like many other carriers. And if you had an application in-house, we are always going to issue to the highest rate. However, in a falling rate market, if you're doing a 1035 or something like that, as long as we have paperwork in good order in-house, then we will be able to offer you the rate of that application and not the lower rate. That's always good news. So like I said, we have a 3, a 5, and a 7-year rate guarantee, and you'll notice that the surrender charges are 765 in the first 3 years, 4.3 in the next 2 years, and 2.1 for that. So 3, 5, and 7 years. Like I said, it is an MVA contract, and it will renew if you don't take advantage of the 30-day window to a new 5-year with a reduced surrender charge. So we go from 765 to a 54321. So every contract is going to renew to that 5-year. As far as my 30-day window, we will send a letter to your customer saying on day 60. So this is 60 days before the end of the contract. 60 days before the end of contract, a letter goes out to your customer and says, hi, your 30-day is coming. And then on 30 days, we send another letter to you and them that says, hi, your 30-day is here, and this is your renewal rate. And then you have the opportunity to shop rate, determine what's in their best interest, and move forward from there. Any questions on that so far? Okay. So like I said, we have a 3, a 5, and a 7-year rate guarantee. You will notice that we have the same interest rate regardless of the premium deposit. So from $5,000 to $5 million, my 3-year annuity is 2.2%, my 5-year 2.5, and my 7-year 2.8. And that is a huge advantage, especially as we enter our IRA season where people are looking to drop in those contributions. These rates at that level of premium are pretty substantial. Okay, it's also very nice at over 100,000. We find that our rates are pretty top tier, and that our service and our new business processing times are pretty substantial. And I'll let Specific Solutions tell you how wonderful we are there, but I'll brag a little bit myself. Our turnaround is pretty high level and very efficient. To be perfectly blunt, when COVID started, we went through tremendous growth because our interest rates were pretty high compared to the nation. On a national level, we were killing it, and we got in more business than we were able to handle. But that's a good thing. The company stepped up, they built in, we hired all sorts of new people. We opened up 2 new offices, one in Charlotte, another one in Roanoke, and we are on top of every aspect of this. And again, I'll let Specific Solutions tell you how wonderful we are. So besides the 3, the 5, and the 7-year rate guarantee, there are 4 options in our policy. The base policy, Select Choice 1, is old school annuity. And it says, you're going to give me the money, and it's RMD friendly, but other than that, no liquidity. So as you're sitting with the customer and you're discussing need, you're going to say, do you need access to the money? And if they don't, well, maybe you drop it into my 5 or 7 year, take advantage of that very high interest rate, lock it up. It is, again, old school. We're going to take the money, hold it, give you the interest compounded annually. And at the end, you have your 30-day window and you pull the money out. If it is IRA money, meaning you're rolling over another annuity and it's IRA money, or they're sitting on some other IRA account somewhere and they only need their RMD, then you're going to go with option one, get the higher rate and take the RMD. The RMD is available in year one. So that is an excellent option for those scenarios. If you have a customer and they want a good rate, they want to put the string on it. Here's my money, but I may want to tug it back. Then you're going to go with the guaranteed return of premium. And the guaranteed return of premium says at any time, if you need your money back, here it is. So you give me $50,000, you get $50,000. You don't get your interest, but we're not charging you any surrender charges. If they like the I'm going to grab my interest at the end of the year scenario, then you're going to want option three, which is my base policy plus the penalty-free withdrawal. So the way my penalty-free withdrawal works is you take the contract, you hold it for 1 year because there's no withdrawal in the first year, but day one, year two, you're eligible for a one-time up to 10% withdrawal. So if they want to pull their interest, no harm done. So I'm going to say this again. Day one, year two, one-time withdrawal up to 10%. So if you take 5% in the 13th month and in the 15th or 16th month, you come back and say, hey, can I have my other 5% because I'm allowed 10, there will be penalties on that. So your first withdrawal up to 10%, no penalties. This also comes with a 90-day confinement. So if you have a terminal illness, hospital, or nursing home confinement for 90 days, then you could have access to your money as well. Option four is all three, the base policy plus the guaranteed return of premium and the penalty-free withdrawal. So some guys like to mix and match, customers in a fluctuating interest rate may not be sure how long they want to lock up their rate. And although it may be a little more paperwork for you, you could ladder this. Let's throw some in there, 3-year with the guaranteed return of premium so I could grab it and pull it out if interest rates go up. But I'm also going to take advantage of the 5-year rate for the other half of the money just in case I want to leave it there or whatnot. It's just a way to mix and match and kind of get to that customer's needs. We do not take, so this product is for individual, business, trust, Roth IRA, regular IRA. Those are the things for ownership. It is owner driven. So we take, joint owners, not joint annuitants. We don't take beneficiary IRAs or stretch IRAs. And currently when we make a payment, it is by check. So if you want to take that penalty-free withdrawal, we're sending you a check. If you want to take that penalty-free withdrawal, but you want it monthly, you can't do it because that would be more than one withdrawal in a contract year. And then you're paying surrender charges. But those kind of like itsy bitsy details, when you got a case, the guys over and women at Specific will help you design it. We have a very rudimentary quoting system. It just shows the accumulation rates on our select choice. So here I have a 70-year-old for $100,000. It's my 5-year annuity with the penalty-free withdrawal. And after 5 years, here's your $112,590. This guaranteed value shows the 2.4 and then a 1% every year after that. This projected value shows the 2.4 and it rolls over at 2.4. We don't show withdrawals. We don't show RMDs. It's just, you could do this on a calculator, but, some guys like to print it out and some customers like to hold something. They all like the shiny glossy paper and this will suit that need. I put it here because this conversation is supposed to be about fixed annuities versus asset transfer. So, our friend Lou George, I don't know how many of you get to talk to Lou George, but I'm going to steal a term from him. And it's, whether the customer needs this money to live on, or whether they are growing this money because they would rather leave it on. So am I going to live on it, or am I going to leave it on? Is it money for me, or I'm just going to grow it because maybe I need it, but if I don't need it, I want it to go to my family. And we know that having a fixed annuity, 90 something percent, people die with their annuities, and there's special taxation on that. And, we'll talk about that on another day. If this money is maybe I need it, but I'm probably going to leave it on, or if this money is, I definitely want to leave this on, then that is the conversation for legacy solution, which is my wealth transfer contract. So this is suited for the client who wants to leave that inheritance. So if you're having the conversation with your customer and they talk about a legacy or they talk about inheritance, then you should talk about this contract. Not for all the money, for some of the money, okay? This is efficient because why? All right, come on, we're all licensed agents here. Tax-free death benefit to the beneficiary. No probate, no arguing. Here it is, okay? It's going to grow tax deferred. All of our accumulation values and death benefit are guaranteed. It is a simple one-time transaction. So we're not worried about, what's going on in the market. We're not worried about what's going on with interest rates. For this portion of the money, I'm going to put it in this bucket, and its purpose is for my beneficiary. Okay. But they do retain control over these assets because they can change the beneficiary. They can change their mind. And that's really where the value of this contract comes in. So when you run a quote, you're going to get this page, which is a quick little summary page. And up in the right-hand corner, let's start in the left-hand corner. We have loving grandma, and she is also 70 years old. Okay, just like my 70-year-old annuitant. You're going to see here that the single premium is $100,000, and the amount of insurance is $157,400 and change. So that 157 is the initial amount of insurance, as it says here. And that 157 is the guaranteed minimum death benefit for this contract. So at age 95, your family gets 157. Throughout the life of the contract, your family will get no less than the 157. And the values here at age 95 will remain level to the maturity of 121. I stumbled over that. Let's try that again. The 157 is a guaranteed minimum death benefit. You'll see it on the summary chart here, age 95, 157. So you talk to your client and you say your $100,000 will be 157 income tax free to your family and no less than that. And the values at age 95 are going to maintain level, this cash value and that death benefit, until they are age 121. So if they live to 121, we pay out the values. If they leave us sometime before that, we pay out the death benefit. So we're talking about a customer and they are not certain whether they need this money to accumulate for themselves or they need the money because they want to leave it on to their family. 157 guaranteed minimum death benefit. If we look here at the summary year of one, the contract fund is the internal growth of the contract, $102,000. The cash value is the surrender value of the contract, guaranteed return of premium. This money will always come back to them. They will never go negative. So there is zero risk here. But the death benefit in year one is the $194,000 and change. So again, loving grandma, 70 years old, you're sitting on $100,000. Do you need to live on this money or do you want this to go to the family? In year five, the death benefit is $193,000. The contract fund, $111,000. The cash value, 106. So if she wants to get out, she's got $106,800 in change, only, as soon as 5 years out. She'll never go negative because she's got the guaranteed return of premium. In year 10, there's $122,800 of contract fund and surrender, because there's a 9-year surrender charge on this. So by year 10, those values are equal, and her death benefit is still $190,000. If we look at this $122,800, let's do the math. That's 2.28 guaranteed net to her after cost of insurance, expenses, fees, charges, etc. That is something to talk about, because if she's just sitting on this annuity, where's the value? So this this policy, besides, if I come back up here, this chart, you'll be able to have a year-over-year quote. So we have the first year surrender, $100,000, 5-year, 106, and then 10 years out, there's your 122. Inside the policy, 111,800. So if this money is sitting in an annuity and it's just rolling over year after year, she really has proven to you that she doesn't need this money. And maybe it's time to have the conversation about, well, if you're not sure you need it, or if there's a chance you don't need it, why don't we take advantage and get this 2.28% net to you guaranteed? And if you leave us, here's $190,000 worth of death benefit. Does that make sense to anybody? And again, the family will never get less than the 157. So again, the reason why my death benefit starts higher at the 194 and comes down to the 157, beg your pardon, is because my contract is a single premium universal life. And we are subject to TAMRA and TEFRA and that IRS code 7702. And if you remember from the back in the day in the 80s, there's that corridor that pushes the death benefit up in the first years. It's a modified endowment contract, but if this death benefit were any less than the 194 or 435, then it wouldn't be qualified as life insurance. And as the years progress, that corridor between the $100,000 and the death benefit reduces. So by the time you get out here over to age 95, it's $144,000 and change of cash value and $157,000 worth of death benefit. And that's the IRS rules. We're not trying to, cheat a customer here because, of some mortality chart. If anybody needs more information on that, we'll be glad to explain it. So those are the two options here, and that's really what we're trying to say. It's the fixed annuity versus the asset transfer. So if I cut and paste here my charts, and I'm sorry if they're a little blurry, but my PowerPoint skills are not really that good. We started with my select choice, $100,000 5-year option 3 with the penalty-free withdrawal, 2.4%. And at the end of 5 years, it grew to 112,000. And if we keep that 2.4 for the next 5 years, we're at 126. My legacy solution, $100,000 female non-tobacco, age 70. And age 70 here, folks, this is our wheelhouse. 65 to 75 is really the customers that you want to be talking to about this product. It is issued down to age 50 and we go up to age 80. So it works for them as well. But the 65 to 75 really is our target market. And if we look at the contract fund, so this is money is currently in an annuity and it's just rolling over and rolling over. In 5 years, they've got 112,590 here, but I'm not going to take it I'm going to roll it over again for another 5 years and get the 126. Well, my contract fund, the money's actually working inside the policy, and I got 111,800. I mean, one of these days I got to do the math, but I mean, that's less than $1,000 difference, right? And the guaranteed surrender value, if she wants to get out, is 106. But in 5 years, the death benefit is 193. And that's where the aha moment is going to come in when you start showing these numbers. If they hold it for the 10 years, 126 versus 122.8, another $4,000 difference, really insignificant over a 10-year period. And we're still at $190,000 worth of death benefit. Mr. and Mrs. Public, I don't think they're aware of this kind of a product, that this option is available to them. And I really think it's a conversation that needs to be had. This contract is simplified issue. So we're going to ask 5 questions here. In the past 5 years, have you been diagnosed for congestive heart failure, cancer other than basal cell? Have you been treated in the last 10 years for heart disease, heart attack, stroke, mini stroke, heart valve disease, aneurysm, peripheral vascular disease, carotid artery disease, Alzheimer's, dementia, emphysema, chronic obstructive pulmonary disease, or chronic bronchitis? So those are the significant cardiovascular and cognitive problems. We're not asking about high blood pressure. We're not asking about cholesterol. We're not asking about diabetes. We're not asking about hip and knee replacements. We're not asking about COVID. Number 3, HIV or AIDS. Number 4, have you been declined? And number 5, everybody laughs at this because we're really selling this to, loving grandma. In the past 2 years, do you have more than one conviction for a DUI? All right, so those are convictions. So if grandma's got one conviction and a second one pending for within a 24-month period, if you extend the court date outside that 24-month period, you can answer this question no. So besides no's here, we're going to run the MIB and the script check, and assuming everything is clear, you submit a paper app, and within a couple of days we have an answer. Like I said, ages 50 to 80, matures at 95. Boy, I really cut off the screen. Minimum is $15,000. Everything's guaranteed to 121. Simplified issues, smoker, non-smoker, male, female. There's a unisex weight chart that obviously favors women, and the amount of initial premium we could take for this expedited approval is 50 to 59, 250, 60 to 64, 175, 65 to 70 up to 150, and 76 to 80, 100. And that's that, folks.
Steve, thank you so much. Fantastic information. Really appreciate that. I have the question and answer box up in the chat. I don't see any questions here. I know we've got a minute or two here before we come up on time.
Right.
Were there any questions for Steve?
I'm going to let you guys separately discuss on a one-on-one basis the commission differences. Obviously, our life insurance policy pays a little bit better than the annuities do, but I'll let those details come out.
Steve, we did get one question. Are declinations reported to the MIB?
That's a great question, and it's really, really important. So when you do the application, you're going to say no to all the medical questions, right? So you're going to know up front, assuming your customer has been forthcoming, that's part A. When we run the MIB and the script check, our prescription, the system we use is a scoring system per prescription. So let's say you take 2 or 3 prescriptions, and each prescription has a certain score. When you add up all of those scores, if it comes between 0 and 6, then it passes. 7 and 8, we're going to refer to underwriting and ask some questions. A 9 and 10, no thanks. So if we have a breakdown in our communication with MIB or script check, if we have them, it'll be a refer to underwriting. If we have a question about that, we will refer to underwriting. We will go out and ask more information. If we are not going to extend an offer, and here's the answer to your question, we will notify you that we will not extend the offer, and you will tell us to withdraw the application. And therefore, there is no reporting to MIB. So that's real important. You need to get back to us and say, please withdraw the application.
Perfect. Thanks so much.
Well, I think I stayed within my time limit. That's unusual for me.
Well, we certainly appreciate your time this morning. Thank you. If there are no additional questions, then we thank you for joining. We truly appreciate your time. And there will be a follow-up survey that goes out. So please, give us some feedback on that. We'd appreciate you, taking a few moments just to respond there. Again, thank you so much. And we hope you have a fantastic day. Take care.
Thanks, everybody. Bye now.